Hey guys, so I don't think you can talk about indicators with at least mentioning moving averages. Now, moving averages, kind of, I think people oversimplify the way they're used, and often, you see people with videos saying, listen, you buy the crossover here, you sell this, you do that. Unlike any tool in trading, if you use it in the wrong environment or the wrong position, it's just not going to be of any use to you. In fact, it's going to be a hindrance. However, if you know when to use the right tool for the job, when to use the right strategy, when to use the right indicator for that specific strategy, which market to use it for, then it can become a very powerful tool. Now, moving average is a very simple thing. It's just purely, as it says, it's the average of price over the period. So, for example, if you have a 5 period moving average on a daily chart, it's taking the average price over that 5 days and is plotting it. Very, very simple. You can have a 20 period, another popular one, 100 and a 200. Those are some of the popular ones. But again, some people will say you've got to use certain numbers or whatever. It's all very, very similar. Ultimately, the point is you've either got a very, very quick moving average, which is going to be like 5, you've got a medium, which is going to be like 20 or 50, and you've got a higher one, which is going to be like 100, 200, that kind of thing. And if you can see just visually here, I've got a daily chart of the Dow, and let me thicken this up a little bit so you can see it compared to price. Obviously, you would normally want to have price right in your face, but for this example, so we can see. So I've got here, I've got a what's this one, 200 period, I've got a 20 period, I know that's my 20, and I've got a 5 on the red. So you can see the difference, right? The 5 is very much because it's taking a far shorter time period. It's going to be far more of a quicker move. It's going to chase price a lot more. A 20 less so, a bit smoother. And then obviously the higher time frame, the 200, was it 200? Yeah, 200 is going to be taking 200 average. So if you get an aggressive move in sort of 3 or 4 day window, it's not going to show on that higher period moving average than it will do on the lower one. So the point is, guys, is that it's a good visual way of looking at the chart. Okay, I'm not a big fan personally of just saying I want to take crossovers, I want to do this. Not that that's valid, and there are strategies out there that work perfectly well in the right conditions using moving average crossovers. I prefer to use it in terms of just framing price and guiding me for my strategy. Now, what do I mean by that? So let's say, for example, I see a good uptrend. Let me get the drawing pad out. A good uptrend. I want to get involved in it. It's on a daily. How do I get involved in it? Well, there's two ways of doing it. The first one is I can say, listen, I'm really aggressive. I want to be really aggressive on this. It's a good strength move. We're sort of flagging here. I need to find a way of getting involved. I'm going to use something like a 5 period that's going to hug price really tightly to catch those really tight consolidations. Okay, that's my first phase of looking at it. My next phase is going to be, that's my uptrend, is looking at something like a 20 period to catch the kind of shorter term but still first primary pullback over a few day period, rather than the tight consolidation, the sort of bigger pullback. And if you look at this example here, in fact, it's for the Dow, the 5 period here is what I'm talking about. If you're using a 5 period to join the momentum, it's very tight, it's very aggressive, you've got to have a very tight stop on it. It's purely a case of here's momentum, bang, slam, neutral, 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 bang, straight back in again. That's the point of using the 5 period. So the drive up, the 5 period hugs it, comes back, tags it, then a second leg, perhaps a third leg. That's showing you extreme momentum, extreme aggression. The second way of doing it is to use the 20 period, which is letting things unwind a little bit more. I prefer the 20 period on a lower time frame for day trading perspective, but you'd be surprised how often the 20 period comes into play and kind of frames the market. Yes, we went below it a little bit here. Again, nothing is perfect, and if you go out there and trying to find perfect, you're going to struggle, but it guides you, it gives you an idea of saying, listen, we've had a good move up, we've had a good momentum, we've had good strength, we've moved a good excursion away from the low. A lot of people are perhaps trapped short. First unwinding, 20 period comes up, starts to tag it, I can start to look to get involved and then subsequently get a further drive. And then if you look on a really long time period moving averages, when you're in a really strong trend, they tend to contain these extreme moves. So we had kind of the moves from Brexit and from the elections and all those kind of stuff. It just generally sometimes will stop momentum in its tracks and give it a push back in a direction. So let's move on to a short time frame, because this is kind of my domain as opposed to the swing area, and I'll show you some stuff. In fact, you know what, let's look at the DAX, because the DAX is open and we might get to see something a little bit better. Yeah, let's use this. You know, I don't want to cherry pick stuff, but let's use this kind of thing. So the cash opens today at 8 o'clock. We get a drive lower, and the 20 period is what I'm really looking at. So let's dump this for now, because like I said, I don't really think that those are so good on the shorter time frames. 5 period to frame it, 20 period perhaps take the signal. 8 o'clock opens, drive lower, reasonable drive lower, not huge, reasonable, comes back up, tags your 20 period. Yes, you got a little spike above it. Again, nothing is perfect here, but it kind of frames that before you get the second drive lower. Frames it again, keeps it in check, keeps it in check, keeps it in check, stalls a bit as we sort of congest around it. So, you know, it's a good way of framing what you're doing. You're saying, listen, I want to wait until the market comes back and tags that moving average. I want to wait until I see, you know, the 5 period maybe consolidate and cross back over the 20 period. And actually, you know, something that you may do, we're talking about crossovers not being as effective, but a good way of filtering is to say, listen, I want to get short here, but I want to wait until I've had the 5 cross over and then back again. So in other words, there's your 5 coming back over your 20. And then I want to take it as it's shown the unwinding, but then momentum started again. So in this case, it would be like around here. You see, you've pushed back up. It might even be here if you're being really picky. But this is not a great day, for example, guys. You know, you want something a little bit more broad, a little bit more strength, a little bit more volume, a bit more volatility in it. But you kind of get the idea. When you cross back over the moving average, wait for the momentum to start again by that trigger of the cross. So that's the only kind of time that I would prefer. I wouldn't mind using the crossover strategy. But it's a way of framing price, it's a way of looking at it, it's a way of keeping on the right side of momentum, it's a way of, you know, perhaps not getting too carried away if we're too far away from the moving average, maybe just waiting for the pullback to get short on it, and guiding you and not chasing things. So plenty of ways of using moving average. I would never say rely on one thing, and never moving average or anything to rely on. Price is always really the most important thing, but it's good to eyeball, it's good to see where you are. And also from a filter perspective, you know, in your charting packages or your screening software, you can kind of use things that say, listen, I want to take things that are, you know, really far away from my 200 period, so that's going to basically filter stuff that are in a really brutal up or down trend, or I want us to take things that are really far away from a 5 period, which is really going to indicate very short-term explosion. So knowing how the different time periods of the moving average, you know, the hundreds, you know, 1 sort of 5, 20, 100, 200 kind of things, knowing how they relate to price is going to allow you to filter things more effectively. And so you understand in your head and say, well, I know that if we're well away from a 5 period moving average, we are talking extreme short-term momentum, which I may want to get involved in for whatever reason. If we're way away from our 200 period moving average on a daily, I'm talking about a good long-term multi-year trend that's really stretched that I maybe want to find a strategy around, that kind of thing. So they're good as a base kind of foundation framework for structuring a trade around. Underutilized, I think, and in some cases overutilized. Some people just focusing on that exclusively. But again, like all things, using the right position, that they're a great tool. So, you know, they're a great tool using it when you've got it in the right area of price is what I'm trying to say. So in other words, when it's trending for that pullback, when it's range bound, not so much because it's crossing so often, but good tool, worth looking at, worth experimenting with those lower and higher time frame settings.